Hey everybody, I am really excited to have the opportunity to share with you again today. By the end of this video, you will know what a stock is and how stocks work. I'm excited to tell you that we just launched our free course, Stop Investing Like They Tell You. You can find it at Spicer Capital University. This is just one more clip from that course. It's from one of the 17 video lessons. It's about 6 minutes of the roughly 4 hours of video content. This is the part in the course where we cover the basics. It's between where you understand the potentially ruinous flaws with the way everyone tells you to invest, the way you're likely currently invested today, and some of the potential solutions. You gotta understand the basics before you can understand the solutions. So that's why we're talking about stocks, one of the basics. And although I hope you check out the course, whether you do or not, everyone should know how stocks work. If you want to invest, you gotta know how stocks work. So without further ado, let's go. I gotta work on my time. So let's talk about stocks and understand them at their most basic level. Stock is an investment security representing actual ownership in a corporation. When you buy a share in a company, you now own stock in that company. You are now part owner of that company. Now in the past, the shares were represented by physical pieces of paper that were shipped around as investors bought and sold their shares. Today, however, that's not necessary. Everyone's ownership is now just digitally logged somewhere. Fun fact, if you would like your actual stock certificates, you can still call the company and request them. They are legally required to mail them to you. Let's consider the hypothetical example of your own company, or perhaps it's not a hypothetical. Perhaps you actually own your own company, and this will ring a lot closer to home to you. So you start your own company and you own 100% of that company. There may only be one share, but you own that share. You own 100% of the shares outstanding, the one share outstanding. And consequently, you own 100% of the company. It's all yours. You decide that you want a partner. You identify somebody that you believe will dramatically improve your business. You offer her 25% of your company. In order to make that possible, basic math would suggest that we at least have to split that one share into 4 shares. After completing that split, we can now pass one of those shares over to your new partner. She now owns 25% of the company. And with your 3 shares remaining, you own 75% of the company. Assigning a value to each of those shares, again, is pretty basic math. You just need 2 numbers: the total number of shares outstanding and the total value of your company. You simply divide the company's value by the number of shares outstanding. So if in our example, you grow your company to a $1 million valuation, you could simply divide that $1 million by the 4 total shares outstanding to come up with a $250,000 price per share. Of course, the goal would likely be to grow your company, at which point the value of every share would increase collectively. If it grew to $2 million, each of those shares would now be worth $500,000. So your ownership with your 3 shares would be worth $1.5 million. At the same time, if you fail or something crazy happens and the value of your company drops to $500,000 total, each of your shares would have dropped to $125,000. And of course, if your company went bankrupt or just out of business, the value of each share would be worth 0. That's it. You get the idea. It's a pretty basic math problem. As long as there's a willing and able buyer, this is the case. For small privately owned companies, this can be hard to determine at times. But in the public markets, especially with larger corporations, that is almost always the case. There is almost always willing buyers and willing sellers. Almost always. This is likely where you'll find all of your current stock exposure in these large public markets. So where do these public markets come from? How does a stock go from 4 private shares to millions of publicly traded shares? As a private company continues to grow and decides they need more money, they can choose to go public. This is done through an initial public offering, or IPO. They sell a piece of their company. It could be 25%, 50%, 75%. It all depends on the company's value, their need for capital, the ownership with which they're willing to part, and so on. They divide the entire company into millions of shares, separate out that portion that they like to sell, and then offer those shares in their company's initial public offering. After people have purchased those shares, A market arises of willing and able buyers and willing sellers, and they will exchange with each other. Now, the actual breakdown of ownership is regularly changing. All the people who hold all those shares at any given point in time are the actual owners of the company for that moment in time. Let's consider one more example. This time, let's explore one of the largest companies in the world, Amazon. If you buy or own a single share of Amazon, you are literally a part owner of the company. In fact, if you purchased enough shares to have a substantial position in the company, you could actually influence decisions. With some companies, it would be possible to purchase over 50% of the company's total shares. People do that sometimes. Other companies do that sometimes. You quite literally own the company. With Amazon, as our example, we're talking about roughly 484 million shares outstanding. When you do the math on that, your one share would represent a 0.000002% ownership. So in this case, that may feel insignificant, but you are still a very real owner. And that's true for any publicly traded company. As you accumulate more Amazon shares, your fortune, at least relative to the amount that you own, is going to move in tandem with Jeff Bezos, the CEO and founder of Amazon. He's still the largest stakeholder, owning roughly 17% of the company. As his fortune climbs as a result of Amazon increasing in value, so will yours. The same is also true from the other perspective. If Amazon goes bankrupt and is now worth zero, your position in the company is also worth nothing. But the same would also be true for all the other owners, including Jeff. There you have it. That's stocks in a nutshell. It's the basic, what you absolutely should know explanation. Obviously, there's a lot more to it. There's a lot more to actually trading stocks. This was just covering the basics about stocks. There are absolutely more questions you can ask about stocks, especially if you want to trade directly in individual stocks. I'm sure you have at least one more question about stocks in you. So head down to the comments, let me know. I'll be there answering questions. If enough people are asking the same question, I'll make a video out of it. And if you're looking for more videos to kill time right now, you might as well check out the course through the link in the description. It's free, it's gamified, and it'll have you questioning the way almost everyone tells you to invest and on a path to better protecting and growing your life savings. That's my mission, that's my goal, that's what I want to share with you. That's what I share with you in that course, and that's what I will continue to share with you on this channel. Thank you for sticking around. Thank you for watching this whole video. Thank you for letting me share with you. If you liked this video and appreciated my time, leave me a like, and I hope you'll consider subscribing. I wish you all the best. Take care.